get to the heart of the discussion, let's get into what is the advisor to do? What is the average financial advisor to do? Well, first of all, the average advisor, I would say 95% of the financial community uses something called the balance of 60-40, 60% stock, 40% bond. That has been the most popular mix in the financial community for a very, very long time. Now, why is that? Let's take a look at 08. In 2008, you would have only lost about half of your money. The market was down 40. I'll blow that up for people in the back. With a 60-40 of stocks and bonds, you'd have been down about 20. Did drag in 09, because in 09, I'll blow this up, you could see the market was up almost 30%. The 60-40 captured about 44% of that upside, 43.91. Well, here's the problem. Last year, the long bond got destroyed, and the stock market got destroyed. So last year, the 60-40 was a train wreck, I got a call from a Merrill Lynch broker. He manages about $1 billion, and he goes, I don't know what to do. My clients are in 60-40. I was looking through your website. I see you guys hedge. I'm kind of looking for advice on how to hedge because my clients are freaking out. But that's why the 60-40 just did underperform. Now, here's what we really have to understand. Interest rates were going up, the blue. And that means when interest rates go higher, bonds go lower. There's an inverse relationship between the price of a bond and the interest rate. Bonds go down, interest rates go up. Bonds go up, interest rates go down. We've been in a bull market in bonds since 1980, 40 years. So that 60-40 has done quite well. Veronica, the 60-40 has done really well because as the market has been volatile, if interest rates are falling, those bonds are acting as a parachute. But if that's over, if we're in the world now where we're going to have bonds start to fall and the interest rates start to rise from this 40-year low, then going forward is 60-40 even a viable strategy? And what does that mean for the average financial planner? Is what has been embedded in the ethos of planning, that paradigm, has it shifted? And that's scary. I think that's scary for a lot of professionals that were raised, as young kids and as, going through their financial planning classes, the 60-40. Well, that's very interesting. So what are advisors doing? And I hate to say this because this is about a week's worth of flyers. How many people get these flyers to go to dinners in the mail? Yeah. And it's funny because I talk to Kelly, who runs the thing here, and she said, we do about 2 of these a week. Financial conferences. And then I was over at Shanahan's, and I said, how many of these you do? We do about 2 a week. And they're all giving you a $100 dinner and unlimited drinks. And I'm looking through these flyers, and it's all guaranteed income for life, guaranteed income for life. And what they're doing is they're selling you annuities. Now, annuities are interesting because I could tell you horror stories about annuities, but really annuities are about the devil in the details. But that's really what the average advisor is doing. They're saying, well, the market's terrible, so let's just put your money in something called an annuity or fixed index annuity. And it's kind of, I've had a good number of clients walk in my office. John, a good number of clients walk in my office and say, hey, I just bought an annuity. It's the best thing since toasted bread. It gives me 7% a year for 10 years, and then I don't have to worry about the market, and 7% a year is good. But then they find out it's not 10 years, it's 30 years. They get 7% over 10 years. They get nothing over the next 20, so their annualized return is about 1.5% over 30 years. And I said, so you just put $1 million in something that's going to pay you a 1.5% return, and you're locked up for 30 years. Are you happy with that? My client says, absolutely not. Well, that's what you just bought. Well, the insurance salesman told me something different. Can I get out? No. I'd like to get kissed before I won't go there. But I could go on. It's a compensation scheme. The average annuity pays a 10% commission. $1 million client walks in, he says, yeah, are you telling me I can get market returns, I can get a bonus, I can get this and that? They're not reading the fine print. The devil's in the details. The advisor or the financial planner just walked away with a $100,000 commission and a new Tesla pulling out into the driveway. One client, one sale, one day. That's what drives annuities. But it's sad because $3 trillion is a lot of money, and it's mostly being done to seniors. So what did I do? I sat down with Mallory and I sat down with my team. I said, enough. So I created a YouTube channel called I'm the Anti-Annuity Guy, and I give away a free booklet. The devil's in the details, right, Rick? The devil's in the details. Yeah, because detail says, I'm to senior. Says, I was in the down with my free book. Sat down, giveaway. So giveaway a team. I said, $3 trillion in the detail. A lot of money being done to seniors. And I sat